name is Dana Golden. Today we're going to finish up with our look at commodity markets, with finishing up our look at market microstructure and regulation. And I think the most classic thing people think about as associated with market microstructure and associated with how market microstructure works is the order book. The order book is a real-time, continuously updated list of buy and sell orders in the market. It displays the number of contracts that buyers and sellers are willing to trade at different prices. So when you see a price in Robinhood, that's not really the price. That's both current trade traded at now, but you have people throughout the market who are supplying bid orders to buy, which represent the price and quantity that buyers would pay, and then you have ask orders to sell, which represents the price and quantity that sellers want to accept. If these things are different, there's a bid-ask spread, and they have to move together to overlap for trades to happen. This is usually where liquidity providers come in to deal with the bid-ask spread when the buyers think it's worth something different than the sellers. And really, you can think of these as a demand curve in the market, and how, when you're dealing with an actual market that has to balance, how does demand equal supply? You can put in different types of orders. A limit order is an order specifying the price at which a trader is willing to buy or sell. So if it gets to this price, I'm willing to buy it. If it gets beyond this, I'm willing to trigger a buy or a sell to get out of my position. This is how you deal with liquidity engine. Is normally you have a limit order so that you're not on the hook for more than you need if the market starts moving quickly. But this becomes a problem because you might have a bunch of limit orders triggered, and now there's a huge amount of selling, even without a interaction from people who are looking as to whether or not this happens. So this just mechanically moves the market. And then you have market orders, which are orders to buy or sell immediately at the best available price. In this case, you look at the best sell order for the player. So you look at the sell order at the lowest price, which is good for the buyer. A lower price is good for the buyer. And you look at the buy order, the highest buy order, which is good for the seller. And then the market order just immediately looks at that and picks up the best one. So mathematical definition of an order book, you have BI of P and Q. You have the bid IDs, which are the demand side. You have the ask orders, which are the supply side, have a set of prices and quantities. And you have a set of bid orders ordered by price from highest to lowest, and you have a set of all ask orders sorted by lowest to highest, and this creates a supply and demand curve in the market. So the order book can be represented by two functions, B of P and A of P, which give the total quantity available at or above a bid price or at or above an ask price. So the amount of bid is the amount of quantity that is greater than or equal to P. So this is the amount people are willing to buy at price P. And then the sell is on the other side, how much people are willing to sell at or below price P. Because sellers want high prices, buyers want low prices. So this ends up with what is the supply and what is the demand if the price is P. The market reaches an equilibrium when the highest bid equals or exceeds the lowest ask. Then there can be trades that can happen. When the price of the best bid is greater than the price of the best ask, normally a transaction occurs at a price between these. Normally people haggle and figure it out. Sometimes you can't do that. Sometimes what people are willing to sell for is not what people are willing to buy for, and you end up with a liquidity problem. So that's a discussion of traditional order books. And to give you an example of how this works in practice, I want to talk about prediction markets. Prediction markets used to be illegal because they're obvious that gambling can influence real events. The CFTC has had a common belief about prediction markets, and some people said, well, what if I want to hedge against this real-world event? There's pretty much no one who actually is benefited from being able to hedge against macro events. Normally, people who have legitimate need to hedge are trying to hedge against very specific events, and they can have hedges against the effects of that event, but they can make it more specific to their use case because the event can do a lot of other things, and so it's less clear. But some people will argue, well, actually, I don't want exposure to this very particular thing. My risk is this very specific thing, and it's a very macro event, and I want to be able to hedge that directly because I have a feeling about that. Supreme Court legalized prediction markets recently for U.S. customers, so you're starting to see some prediction markets come out. And 2024 was the first time in history when a U.S. presidential election featured deep liquid prediction markets. This is good because this encourages people to spend time making predictions, making good predictions, putting money into predictions. You actually saw some people putting it out polling, which helped prediction markets become more accurate and efficient. We'll see long term whether or not they're actually efficient because, as you'll see next time, see right now, the price in the market is now the probability. Why is this problematic? It can definitely be viewed as gambling, and there's a lot of questions as to whether or not it's a legitimate hedging instrument and whether or not it might encourage you to interact with the market. If you're betting on whether or not Trump is going to become president, are you now encouraged to interact with the presidential election in that way? And so how should we interpret prediction markets? How should we think about the price that we're seeing? So here's the prediction market. I believe this is Polymarket. Yeah, this is Polymarket right there. You have 60.3 and 39.6. When I wrote this, I didn't know who was going to win in the election. Now I do. But one interesting thing is you're buying the contract for $1 and or you're buying the contract for 60 cents or 39 cents, and you're getting $1 if it happens. And some people argue, well, this is the probability. Well, it can't be the probability because 60.3 plus 39.6 is greater than 1. So if this is a probability, then that's not... No, that's not greater than 1. I'm wrong. But sometimes this was greater than 1. Actually, it was sometimes greater than 1. I'm sorry, this right here is not greater than 1, but sometimes was. And this led to the question of, well, if it's not exactly equaling 1, it's actually less than 1, which also makes it not a probability. So if you have a difference, and then here you have, of course, the bid and ask spread. This is how much there's a difference between what people are willing to buy and sell the contract at. So if you have this, if you have these numbers, why aren't they equal to 1? Why isn't this the actual probability? And to answer that question, let's look at what a prediction market is. And remember, the reason why we're talking about this is because the prediction market is a commodity and can demonstrate how the order book works. So prediction markets are exchanges for buying and selling contracts on future events with prices reflecting the likelihood of certain outcomes. Let P be the price of a contract that pays $1 per event E occurs. The price reflects the collective probability that if P, the event E, will occur, assuming efficient markets. Remember, I keep coming back to this in this class, the assumptions are important. You're assuming efficient markets, which don't always happen, and there's a lot of reasons I'll show just now why that might not happen. So each participant I holds a belief P of I, but the likelihood E, they may buy or sell a contract based on the difference between PI and the market price P. If PI is greater than P, the participant believes E is more likely, leading into buying behavior. But why are these not probabilities? Take a sample prediction market where contracts trade between 0 and 100 with a bunch of different traders, some of whom believe one thing, some of whom believe the others. So some of them have a really high probability for an event, some of them have a low probability. Costly arbitrage prevents the market from becoming perfectly efficient. In this case, let's assume that we have some pro-Kamala traders, and there are more pro-Kamala traders than pro-Trump traders, and we have some pro-Trump traders. The pro-Kamala traders believe that there's a low chance for Trump to become president. I didn't make this example. I got it from a very good blog that we'll try to link in the comments of this video. So the pro-Kamala traders are willing to buy Trump becoming president if it's priced at like 1%. They believe that maybe there's at least a 1% chance. They're willing to sell when it's greater than 20, even 30%, because they really don't think it's likely to become that Trump will become president. And so here's the individual order book, and here's the cumulative order book. So, and then here's the other one. This is for the other traders. There are a few of these traders. This is the cumulative pro-Trump order book, and so you have, they really think Trump is going to win. They think that Trump is going to become the president, so they are willing to do the exact opposite trade. They're willing to buy Trump becoming president at anywhere below 75% odds. They think it's really probable. But there's mostly Kamala investors and some Trump investors. So the problem here is that because of the way the order book settles, adding a few Trump investors move the Kamala market more because Trump trades and these investors, because there are fewer of them, and the price is if there's more Kamala investors, that means that the price is somewhere around here. The equivalent price if only Kamala investors somewhere around here. The equivalent price only Trump investors around here. Trump investors are going to see that Trump investors are going to see that the price is really low. They're going to buy a lot of it, and then they're going to see this as a better trade than the Kamala investor would see at the opposing side, because notice there's all this area over here. So just adding a few people who believe one thing changes the prediction market in a lot of ways. And a few Trump investors moves the market more than Kamala investors, because Trump investors have a very different opinion. So it ends up being the price is not the average opinion. Actually, the probability here of Trump becoming president in this case ends up being greater than the market's opinion. So all this to say, think about the order book and think about how the way the order book works is affecting the price of the asset. In prediction markets, the price does not necessarily reflect the probability. So it's just a great example that was provided on a blog. And I hope you have a great day. Thank you.